Are you counting on your rental property to fund your golden years, but terrified that Uncle Sam is going to take a giant bite out of your cash flow? Listen to me. You worked for decades to build your nest egg, and the last thing you can afford in retirement is paying a single dollar more in taxes than you legally owe. So many people enter retirement thinking rental income is easy passive cash, only to get slammed with an unexpected tax bill at the end of the year. They panic because they are living on a fixed income, and every unexpected expense cuts into their peace of mind. The fear is real. What if your rental income pushes your Social Security into a higher tax bracket? What if you are leaving thousands of dollars on the table because you do not know the IRS rules? Ask yourself right now, are you truly maximizing every deduction you are entitled to, or are you just guessing when tax season rolls around? Here is what you need to know. The Internal Revenue Service allows you to write off ordinary and necessary expenses required to manage, maintain, and conserve your property. First, mortgage interest. If you still have a loan on that rental, the interest you pay is one of your biggest tax write-offs. That includes interest on credit cards or loans used specifically for property maintenance and repairs. Second, property taxes and insurance. You can fully deduct the real estate taxes you pay to local governments, as well as your landlord insurance premiums, hazard coverage, and flood insurance. Third, maintenance and repairs versus capital improvements. This is where so many retirees get tripped up. Fixing a broken pipe, patching a roof, or painting a bedroom between tenants are repairs, and you can deduct those costs immediately in the current tax year. But if you install a brand new roof or renovate an entire kitchen, the IRS considers that a capital improvement. You cannot write off the whole cost all at once, you must depreciate it over time. Fourth, the power of depreciation. This is the single greatest tax tool for rental property owners. The IRS assumes residential rental buildings were out over 27.5 years. You can deduct a portion of the building's value, excluding the land value, every single year as a non-cash expense. That lowers your taxable rental income even when cash is coming into your bank account. But hear me loud and clear, depreciation isn't optional, and when you eventually sell that property, the IRS will recapture that depreciation. Track it carefully. Fifth, professional services, property management, and travel. If you pay a management company to handle middle-of-the-night tenant calls, those fees are deductible. Legal fees, accounting fees, advertising for new tenants, and even your mileage driven to inspect or maintain the property are deductible expenses. Here are your actionable takeaways starting today. Separate your accounts immediately. Open a dedicated bank account for your rental property so every dollar of income and every single expense is tracked without mixing in personal funds. Keep a digital folder of every receipt, repair invoice, and mileage log. Finally, sit down with a qualified CPA who specializes in real estate taxation. Taking control of your tax strategy isn't just about saving money, it is about securing your financial independence so you can enjoy the retirement you worked so hard to achieve.